Savjit Chatterjee and Rohan Singh recording our weekly session of Charts for Fun. This is for the week of October 7th, recording this on a Sunday, the October 13th. Last week, key economic data was the CPI and PPI release, which market often waits for to kind of look at the interest rate expectations moving forward. We know that the Fed did a 50 basis point cut. We'll see what the market thinks moving ahead for the November 7th meeting. And also unemployment claims shot back up. This has been a concern for the market. Is the job market really slowing down? We know that we got a very strong September payrolls with 254,000 jobs. Unemployment on that monthly report had actually crept lower to 4.1%. We know that it had come up as high as 4.3 earlier this summer. So market is still not very sure if the job market really is slowing down. We know that Boeing had big job cuts announced end of last week, and the unemployment claim shot up. Now it could be weather related. We know that we had two really unfortunate and bad hurricanes in the Florida Panhandle. So anyway, we'll take a look. We'll see where the market thinks about the interest rate expectations, and also just to get a trend about where the S&P, the NASDAQ 100, QQQ, and Gold and TLT are looking at. We'll just take a look at that. We'll look at VIX, which is the volatility indicator. And then I'm going to end with the financials. The earnings kicked off in full gear last Friday. Typically, when markets earnings kick off, this is for the third quarter earnings. It starts off with the financials, and then from there, the other sectors come in. So we did get two or several big bank earnings. So we had Wells Fargo and JP Morgan. We'll take a look at JP Morgan. And this week in particular, we have Goldman Sachs, call it the investment banking shops, Goldman Sachs and Morgan Stanley. And we also look at Bank of America, which has been on the news quite a bit, is Warren Buffett actively reducing his holding on it. We'll take a look at that as well. With that, let's just look at the charts. So this is our Charts Are Fun Substack blog site. We appreciate you subscribing to it. It's free. You can just use your email and subscribe to it, and you'll get an email as soon as the blog comes out, usually in the mornings. The Charts Are Fun YouTube site, that's our channel at Charts Are Fun. Appreciate if you like the button, hit the like button if you like our videos, and also subscribe to our channel. Wanted to look at Twitter, and in particular, the Kobeissi letter is something I do look at quite actively. They support a lot of the macroeconomic news and so on. So in here, they did touch on the CPI and PPI, which were both slightly higher than what the market was expecting. CPI came out on Thursday and the PPI on Friday, back to back. Both came out slightly higher. So the core CPI was expected to be 3.2 year over year. That actually crept higher to 3.3. And also the PPI was expected to be 2.6. It came in at 2.7. Both of these raise a bit of a concern in terms of where the interest rate expectations are. We look at the CME FedWatch Tool just to get an idea, and we can see that right now, 90% chance, almost 89.5, 90% chance of a 25 basis point cut on the November 7 meeting, but market is not ruling out kind of keeping it flat, as in not doing a rate cut at all, or a pause by the Fed. And that's almost over 10.5% now. So there's a chance this may creep up higher if the economic data indicates that Fed doesn't really have an urgency to do a cut in November. With that, there's also this unemployment claim that I talked about that really shot up higher. It had hit 250 when the market got concerned towards late July. We know that we did get a big pullback from the July to the early August timeframe. Now, again, having come down all the way to 219, below 220, it's now a big jump up to 250. We have 258,000 actually came out on last Thursday. So something a bit of a concern. The market is going to be looking at the job data very carefully. Yes, this is high frequency, comes out every week, but this may correlate down that the downward revision on September may come in. That 254 might have been an aggressive number. In reality, the job market might have been poorer. So until the October data comes out in early November, which will be right around the election time, we would really not know what's going on in the job market. There's also, this is an interesting chart that the Kobeissi letter shared across the last 24 years since 2000. S&P, if you look at all the 24 years are mapped out here from year-to-date gains from January 1st to now, you can see that the blue line represents the gains for year-to-date, and it's hitting at 2% year to date, 22-23, which is more than double of what S&P has had since 1957. An average gain of S&P since 1957 annually has been about 11%. So we are hitting double of that. And also, each of these lines represent the respective years from 2000 to 2024. And we can see that the blue is at the top of the range here. So it means it's at its highest level ever. Now, is this sustainable? That's the question. If you can look at delinquency on the auto loans, not looking so good, especially the subprime delinquencies. If you look at the subprimes are here in blue, it has more than doubled. So it was about the 2% level in the time frame of 2021. In a span of 3 years, it's more than doubled. It's now closer towards the 4.5. It's not 4.5, but 4.2%, more than doubled of what it was in the 2021. So subprime loans getting worse, delinquencies in particular, 60-day delinquencies. And we can see that the primes, which are, not as much of it's more of the high income kind of population, not as bad percent-wise, but still that's also gone up more than double from 0.2 to 0.5. But subprimes, from 2% to almost close to 4.2% of the loans defaulting is not a good sign. So that's something to be worried about. So with that, let's just look at another indicator of complacency, and this does look quite worrisome. It's what we call as the CPCE, which is basically your equity put call ratio. CBOE publishes this on a daily basis. The 10-day moving average of that is hitting or scraping the low end of the last several months. The last time we saw at these levels, closer towards the point, this moving average is the 10-day moving average at 0.55 was around the July timeframe. In fact, on Friday, we closed of the put call ratio at 0.44, which means if you think about it, there are way more calls than puts, more than double of the calls and puts, and hence the ratio is 0.44. And these are equity, mind you. So this means these are pretty much all the stocks out there. If you start doing the put call ratios, do a sum and do a ratio on that of the quotes calls and outstanding puts, there are way more calls and puts. Now that complacency, often when the put call ratio starts climbing, you get a correction in the market. So this is a bit of a concern. We are scraping the July lows, which means if now this starts climbing, we could look forward to some form of a correction. Not something that would be surprising, because we know the market has come up a lot since the August 5th low, and we also know that seasonally in an election year, September, October tends to be very volatile. Yes, we've had the volatility, but we've not had much of a correction. This been a steady upward climbing market. So with that, let's look at VIX, which is the volatility indicator, which is another way to also look at the puts and the calls, because higher the VIX means there's going to be a rising trend of puts that causes the VIX, and this VIX particularly tracks the S&P 500's movements, would mean that there is way more puts buying going on if VIX starts shooting up. Now, this is potentially a concern. Why? Because we see a kind of a cup that's formed from 23.3 on the left brim to 14.9 to 23.14, potentially a shallow pullback, kind of a handle forming. If this does break higher, which again correlates, shouldn't be surprising, with volatility expected in the month of October. We know that many of the crashes have happened in October, so something to be worried about. That breakout of VIX measures 231. Now, VIX doesn't exactly follow technical chart patterns all the time, like the typical head and shoulders or the cup and handles and so on. But in many ways, there is a trend here. The trend is that a shallow pullback and a breakout higher in VIX could mean a market correction, something to be worried about. So that's something that we need to be considering in terms of the next several days. And the chart pattern on S&P 500 is also very bearish. This is a classic rising wedge pattern. A rising wedge pattern happens if you join the lines to the tops and then you join the lines to the higher bottoms. So higher highs and higher lows. If you join these lines, they are kind of narrowing down into an apex. That kind of narrowing down when you're rising wedge, it's a wedge shape, usually is a bearish pattern, which means at some point closer to the apex, it breaks and it breaks lower. That's something to be worried about, something to look at. We can notice that there's also distinct negative divergence when early on, when S&P was a lot lower at 56.69, RSI was so much stronger. Now we are at higher highs, exceeded the 5800, 5815 close on Friday. RSI is much weaker. So momentum is declining, as we can see, as S&P is climbing. And it's kind of, this wedge shape means it's kind of climbing in a narrower or kind of a band over the next the last couple of months. So that is something. Now, AD is extremely strong. AD is at its all-time highs, means there's been strong accumulation, but something to be worried about is if this breaks lower, this could mean VIX correlating with VIX shooting higher. Similar kind of pattern in the QQQ, which is a NASDAQ 100 ETF. Again, a bearish rising wedge. If you join the tops and join the lows, it's kind of narrowing down, getting closer towards the apex. The apex of the rising wedge on QQQ is more towards 495. The one on S&P 500, which is SPX, is closer towards the 58 to 5900 kind of apex. So either of them is a concern, and we need to, be looking at what could potentially happen. Do want to say that in the blog that we do, weekend blogs, which we primarily focus on some chart patterns on some of the key stuff. We did talk about this not just for S&P 500, the SPY, or the QQQ. The Dow Jones, which has been quite strong recently, is also shaping up to a similar rising wedge. So that's a bit of concern as well. Now, the other thing that could happen if the market does pull back, what happens to the bonds? Bonds sometimes, as we know, is contrarian or inverse to the stocks. So now TLT, which is the long-term treasury bond, this is the 20+ year treasury bond, it has come down in the reverse of a bearish rising wedge. This is a bullish falling wedge. And this bullish falling wedge is come to test key support at 93.5. We can see that in the past, TLT in June and July has tested 93.5. That at that point was resistance. Old resistance becomes support. Now we are testing that level from above. This could potentially be setting up for a rebound. So TLT could rebound from safe haven buying. We know that there are concerns with geopolitical. There is a big escalation of Iran and Israel's, constant missiles and fighting back and forth. There is an expected major attack from Israel back to Iran. That is a concern, and this could shake up the market. Safe haven buying can creep in. So while a pullback in equities come in, we can't rule out a TLT rebound and a rally, something to look at. Now, also, we had talked about in our last week's video of an imminent gold pullback, and we did get the pullback. I didn't say a major correction. I didn't say a big sell-off, but we had expected GLD to pull back, and it did. It is on a rising channel. We can see that the tops and the bottoms climbing in a parallel way into a rising channel. It did pull back. GLD did pull back to test that rising channel, and then it rebounded higher. This potential upside on gold is actually a lot higher. And let me just share that from the not just the GLD, the ETF, but the actual gold spot price. And this is, we can see a long term. This is the monthly chart, cup and handle, 1923 on the left brim of the cup, the pullback towards the 1100 level, back to 2089, breaking up after. So it's like a saucer shaped cup, a saucer shaped handle, and then the breakout. That's measured at 3133. Decent upside on gold. And we are right now anywhere around the 2676 level. So you're talking about another less than 500 points, 460 points or so left, or $460 or so left for gold to further rally. So yes, the momentum is definitely on the side of the gold bulls. This pullback was just a buying opportunity in the testing the bottom of the channel. Safe haven buying could mean TLT and gold rising. So it's something to look at for the gold bulls. Now, I talked about earnings kicked off in full gear last week. The key earnings that started off was with the banks. Wanted to look at the ETF for the financials called XLF. And in here, we see a beautiful ascending triangle pattern, 45.7, 45.67. If you join a horizontal line through the highs and then the rising lows, that breakout measures closer to 48.12. We did close towards 46.5. Another, $1.60 or so upside left on this move, and that's possible in the next week or so. Why? Because key earnings is coming up. Let's look at JP Morgan. This is a nice W-shaped kind of a pattern. 208, 200, it tested from 224. Then it kind of went to 211, pulled back to 203, and then it rallied. As it rallied higher, it tested the 224 again after strong earnings on Friday. It kind of closed a little off the high. So for the time being, this could turn out to be a bit of a resistance. There is a negative divergence in JPM with the RSI at a slightly lower high, and so is the PPO. So we have to see if this is potentially hit its resistance level for now, but JPM had a very nice move. We can see that it had rallied 4.44% last Friday on good earnings. Now, upcoming earnings and financials this week is Goldman Sachs and Morgan Stanley, the big investment powerhouses. And we know that both Wells Fargo and JP Morgan talked about strong investment fees and strong investment management fees. So that sector has been warming up, doing quite well. And we can see that in here in Goldman Sachs, potentially a similar kind of ascending triangle as we saw in XLF. Upside is quite a bit higher. It's at 516 is very closed. We see an upside on 592. Been interesting, to see where Goldman ends up after earnings this week, but very nice upside move left on Goldman. Similar kind of move in Morgan Stanley, also a beautiful ascending triangle. So 104 to 90, that's 14 points. Add that to 104, about 118.9, 119 is where that target is. RSI at overbought, but over 70. We can see that PPO is strongly climbing, and it ended near 110. So another 9 points or so upside in Morgan Stanley. Don't expect that to happen on the same day of the earnings, but potentially the chart looks bullish, expecting to see strong earnings from Morgan, and that could mean that Morgan Stanley could have some more upside in the near term. Finally, Bank of America, we know that that's been the news a lot with Warren Buffett, kind of lightening up his position. A very similar ascending triangle pattern on Bank of America, 34.9, close to 35 to 41, 6 points. Add that to 41, 47, 47.17 is the measured target. It closed near 41.95 or 42, had a nice strong 4.95% move on and breaking out above the ascending triangle with good volume on Friday. This is also harboring good news into earnings. So I expect Bank of America, Goldman, and Morgan Stanley, at least from chart wise, perhaps having bullish outcomes to earnings. We'll have to see. It can never say for sure anything can happen with earnings, but seems like these three have upside, which could help take XLF up to its targets towards 46,112. With that, earnings will be kicking in full gear the next couple of weeks. Let's see how the market reacts to it. To summarize, we are worried about VIX potentially flagging a cup and handle. If VIX has to shoot up to 31, it would mean downside for S&P and QQ with these bearish rising wedges, something to really be looking at. Potentially a rebound in treasuries. So for those that are treasury buyers, long-term treasury buyers, a decent chance of some rally coming in or some reversal coming in. And for gold buyers, continued upside. It tested its rising channel, expected to keep hitting perhaps higher highs. With that, good luck investing. We'll talk to you next week. Thank you.